Joining me now for the M&A Edge, John Bintz. He is our mergers man. Good to have you on the show.
Thanks, Angie.
John is with Valuation Research Corporation. Good to have you here.
Thanks.
All right, so we're talking today about unicorns in business. And John, this has been a big buzzword that has emerged. So explain exactly, what is a unicorn?
Yeah, it's pretty simple, Angie. It's a privately held company that's worth $1 billion or more. And currently there's about, some estimate there's about 140 or 150 unicorns that exist today.
Okay, so taking a look at those, we know that the stock market has been extremely volatile. How does that affect the valuations of these unicorn companies?
Yeah, a lot of them, the valuations have gone down. Some mutual funds actually own the privately held companies. Uber is owned, some of the other large unicorns that are out there. And some of those mutual funds have actually marked down the fair value in their portfolio of those unicorn investments. Some between 15 and even 40%, they've actually marked the value down. One of the things that exists when a unicorn exists as a privately held company, they want to go public or they want to be bought out. So a lot of times the preferred shareholders or the early investors, whether it's a venture capital company or a high net worth individual or an angel network, they will get preferences. So they'll get ratchet protection. So if the valuation goes down at a liquidity event, whether it's an IPO or a buyout, they'll get additional shares to protect their investment. They'll also get a liquidity preference, which means they're going to get all their money back plus a return before any of the common shareholders would get their money back, and they would get some type of a preference or additional shares, again, to make up for the decreased valuation.
Well, that's excellent news for people who invest in these companies. They are protected, but what about the employees who work for the companies? I'm concerned about these people.
Yeah, sometimes the story is not a very good ending for them because they don't have the liquidation preference, they don't have the preferred shares, they're only common stock holders. So if the initial investors or the early stage investors or the investors with the preferred shares, they're going to get their money out first. So their value of their common stock might be valued at zero, which means part of their equity, part of their compensation to work there is in the form of equity. They might be working for free. In addition to that, they have a tax bill. So once they get awarded those shares, they have to pay taxes on that, and the value of those shares might not be that when it's time for the liquidity event.
So high risk, but maybe high reward if these companies, these unicorns, turn out to be the next best thing, right?
Correct, but they're rolling the dice. The employees are rolling the dice just like investors are. So the unicorns is something that's happened in the last maybe 5-6 years with increased tech valuations in Silicon Valley and throughout. So we'll see what happens, but it's a buzz term that's come about in the last 4 or 5 years.
And I'm sure with your business you're watching for different names that might be on the bubble.
Absolutely. We're a valuation business, so we're looking at different valuations, how to mark the different methodologies that come to value privately held companies. We'll look at publicly traded comps as well as an income approach where you're valuing the discounted cash flow.
John, always a pleasure. Thanks for coming on the show.
Thanks, Angie.
Still to come, a trader reveals his best trade of the week in a FANG stock. Will it be Facebook, Apple, Netflix, or Google? Find out after the break.